Hey everyone, it's Andrew and Dave here from FTC. We're just going through another topic that's been at the top of my mind over the last few weeks. And following on from our video the other day as well, we're talking about depreciation. So many people ask, what does the different depreciation methods have, or how does it impact their tax return? So I thought we'd run through an example just to give you a bit of an idea how it all works. Okay, so just following on the other day as well, depreciation is what happens when the asset loses value over time. So we're only specifically talking about the building when we're talking about investment properties. The land does not depreciate. So you cannot depreciate the land at all because generally it appreciates in value. So there are two methods, the diminishing value method and the prime cost method. Both methods last for 40 years. However, the diminishing value method accelerates depreciation in the first part of the cycle of the investment property. So if you look here from an example from a depreciation report, you've got the two methods. You've got diminishing value method. We'll look at a full year, 2018, just because it's a full year. And you can see that the depreciation is 13,316. When you compare that to the prime cost method, the depreciation charge is 9,361. So there is a variance there of about $3,000 in this example. So this will obviously impact what your total taxable income will be. So as an investor, you have the choice on which type of method you'd like to choose. So it all goes back down to your personal circumstances. If, for example, your income is really high and you want to utilize more of the depreciation as soon as you get the investment property, you would probably stick with DV. If it's the other way and your income is lower and you're foreseeing your income increasing a lot over the next few years, it may make more sense to go the prime cost method because the depreciation will be fixed each year and you'll get more of the benefit of the depreciation when your income is higher later on. So just running through an example here between the two methods. So say someone is on 120 grand per year, the property brings in 20 grand of rental income. It has total property expenses, including interest, rates, water, and the rest of 30K. That and the depreciation charge of 13,316 from the table before. As you can see, the net taxable income is 96,684. Exactly the same numbers, except the depreciation on the prime cost method side. You can see that the taxable income is 100,000 and 100,639. So there is a difference there of the depreciation charge between the two values. So when it comes down to working out the tax payable, on 96,684, the tax payable is 21,889, and subsequently the same on the other side, the tax payable is 23,174. You've also got to pay the Medicare levy, which is 2% of your total taxable income, which is this figure here. So as you can see, the depreciation charge will also impact the Medicare levy. So if your taxable income goes down, your Medicare levy is also going to drop as well because it's 2% of the net taxable income. So if we add these two tax figures together, you come to a total of 23,822 versus 25,186. So you can see here, just by choosing the different depreciation method, the difference in the tax payable is about $1,300. So it's not crazy, but it's something that you have the option to elect which type of method you want to use. So you can use this to further work out your tax plan or your tax strategy going forward. If you know it's going to cost you X amount of dollars less to use one method than the other, you may decide to switch methods depending on what you want to do in terms of cash flow. Dave, anything you'd like to add?
No, I think that's a great example. But yeah, just of course with a DV method, it gives you a better outcome in the earlier stages of your investment property's life. But eventually there'll be a point in time where that will switch, and then PC will be the more favorable method later on. And so yeah, it all really depends on your strategy and whatnot. And just know as well that if you ever decide to sell the property, then all that depreciation gets added back. And that gets considered when you actually sell the asset, and that will impact your net gain on the sale of that investment property as well.
100%. So if you're unsure about what depreciation your tax advisor is using, definitely hit them up. If you have any questions about this topic, feel free to reach out and we'll get back to you as soon as we can. Thanks.
Awesome. So yeah.